Now, Richard Harris is with us, Chief Executive at Port Shelter Investment Management. Richard, good to have you with us here. Thank you very much for your time. Rates are going back again in the US because data is strong. But I was asking this yesterday, if higher rates did not hurt, and should lower rates or the lack of lower rates, hurt as well? It should be okay, right? The 10-year is around 4.5%.
Yeah, that's right. We are in a bit of a conundrum because, of course, the market has been expecting cuts, 6 cuts, now 4 cuts, now 2 cuts. Perhaps there may be no cuts, and yet it hasn't really reacted negatively despite those expectations. On the other hand, if you think about it, we've got interest rates pretty well normalized now. Money's costing 4 or 5%. If you get it from the Fed, I mean, that's probably about right for your normal economy. And things seem to be going fairly well in the market. So you do have to wonder whether the Fed needs to hurry and continue to cut rates. The big question is, what is the market going to think about that? And so far, it's been pretty well immune to a dashing of these interest rate expectations. So I think while the consumer stays strong, which means employment high, we had some good job numbers the other day, and while corporate growth continues and economic growth continues, I think we'll probably trend on where we are at the moment.
So, Richard, if this year, suppose we get 2 rate cuts versus the projected 3 rate cuts, do you think markets will be okay?
Well, this is a strange thing. We've now gone from 6 to 2 and markets have been okay. Well, in fact, markets have actually been pretty good. And around the world, too, because even the European markets have done quite well. So I think that, at the moment, the market does seem to be fairly immune to bad news about interest rates. And as I said before, if markets are feeling that there are not going to be a lot of defaults as a result of interest rates being where they are now, then why should they necessarily price off? So although I think the headwinds are building towards further rallies, I think that probably we're likely to trend in this particular area for a while.
Hi, Richard. Good morning. Good to see you in. Nigel here. What about the Indian markets? That's a market that's been doing quite well, and we are quite proud about it. And we also have earnings momentum with us and a government that is expected to come in for a 3rd term. Your view on the Indian markets at these valuations?
Yes, I was listening to some of your analyst reports just now, and of course, they're all highly optimistic. And we all are highly optimistic when the market's been doing well. And probably at the moment, justifiably so. I think, there are a number of narratives coming through. Yes, we may well see Western markets start to slow down, but as I said, be underpinned by earnings and high employment. And at the same token, we've got China appearing to come through rather slowly, but I think the authorities will continue to stimulate that economy. And both of those things should actually be quite good for continuation of what's happening in India. I mean, the big issue, somebody asked me a little bit earlier today, what are the risks? Well, the risks that we kind of know of, which is, we've got big debt piles out there. We've got commodities creeping up, gold's creeping up. Nobody really understands why. So there are risks out there, but it's not the risks we know about, it's the risks we don't know about, because the risks we know about are already in the market. And I think, I think for this market to be upset, we're going to have some really quite strong economic event of the like that it's quite difficult to foresee at the moment, except perhaps we may see some triggering from, say, the US election at the end of the year.
Okay, Richard, we'll leave it there. Thank you very much for joining us. It's a pleasure having you here.
Enjoy your holidays.
Thanks very much. Thank you. Well, that's Richard Harris with his views on markets. Generally, I mean, a very benign environment for equities, which should continue. Unless, of course, I mean, something really big happens, which unexpected more than anything else, which is not there on the horizon.